Welcome back, class. And student, again, we will start our lectures about the start. I mean, asset. Asset. We leave it accounting asset definition. That is, assets are economic resources that is owned by a business and are expected to benefit future operations. Okay. Now, with the help of the asset definition, I basically want to discuss about the some principle that related to the assets. Okay. Now, come on our next slides. These accounting principles store the cost based, and cost as the basis of the asset valuation. Fine. First principle that we will discuss about the cost principle, like this one. The cost principle, it will show the mean to say this cost principle will tell the accounting user that accounting information is always based upon the actual cost that should be incurred, that will be referred to in a historical way. Okay, mean to say, if you like, if you purchase a land, if you purchase a building, and you purchase this building, $100,000 in Pakistani rupees. We talk about, we are purchasing any building and the land with the 5 million. Okay, but right now, if we talk about that, we purchase this building in $100,000. After a 5 year, after a 7 year, after a 10 year, the building estimated cost will be the $200,000, $300,000. I mean, normal. We know you people familiar about these things. Real estate will be increasing in all over the world, especially in Pakistan. That will be high rate. Okay, if you purchase a building that may be just 5 million, but after 10 year it may be the 10 million, it may be the 15 or a 20 million, depend on the inflation rate. But in our accounting transaction, in our accounting record, we will not be able to write estimated value of a 10 years. We just write the 105. I mean, that's purchasing price, the price from which we will be purchased this building and the land, that will be just 5 million. Okay, now we will not write the estimated any future value. Fine, it is a cost principle. And second is a going concern assumption that show the assets value. Whenever you will be use the assets value, it will be a going concern. Mean to say, basically, when we make the income statement, it is using for the maximum of a 1 year tenure. Fine. But if we talk about the balance sheet account is using for some accounts, especially the asset like land, building, equipment. We are acquiring these assets for the usability. We are basically interested to use these assets in our future time. We have not acquired these assets for resale purpose. I mean, we are not interested that we are going to be purchase land and building after 5 year, and we have some good amount, we have some good rate of land and building, and we will sell it. Okay, it is not a good idea. It is not a basically in a form of asset. We are just purchase the asset for the going concern assumption. Basically, we, with the help of these assets, we will use, we are do our business. Fine. It show the going concern assumption. These assets are useful for the long term. Okay, that's the second principle of assets. And now talk about the objectivity principle. Objectivity principle of a asset measuring. It is something you say that's related. State the accounting information must be unbiased and based upon the independent evidence. Like already in example, we cost of land. uh, I say I purchased the 5 million. uh, I purchased this land, this building, with the 5 million. Okay, but that's a bookish value, I write it. But when a detail will become, and certified public accountant can easily view, you have any evidence? Mean to say, when we will purchase a land, when we will purchase a building, even though you purchase your bike and any machinery, any equipment, you have some voucher, you have some bill detail, and in a case of a land, you have some stamp registry. You know, these are the basically thing when registry and evidence that providing that's agreement, the seller of a land, the seller of a building, and the seller of a any asset, mean to say your vehicles, car, the mention, the name and the detail of agreement, all things that are mentioned. Then CPA certified public accountant, if have interest, they have can view the detail of the uh, detail cost. He can do easily audit. It is a basically audit. That's a way objectivity principle that whenever you will purchase any asset, okay, whenever you will purchase a fixed asset, you need to be a complete record of your documentation, and you need to be you have to need you have keep the complete evidence of your purchasing slip, your agreement slip of all important assets. Fine, that's the objectivity principle. And the last one is a stable dollar assumption. It is related to your currency inflations. Mean to say, whenever you use your accounting information, you need to be mention a one currency account. If we, I mean, Pakistan-based company, mostly they are using the Pakistani currency, okay, rupees. And if a company using the dollars, then it may be outside the company, even though some companies are close their account and using this amount, if in a form of a currency of a dollar, because of they have a basically multinational company and doing operate in a Pakistan. That's not a Pakistan based company, but they using just one single currency. Okay, it is first decided. Okay, it is normally we are normally businesses are decided which currency they need to be used. Okay, the state where they are operating, country where they are operating, this base country currency they will use, or any native currency they can use. Okay, stable dollar assumption, simply that is the related the concept you will use the single currency in form of all reasons. Okay, you will always report your financial information in a single currency. Okay, it is a asset some principle that we are using the assets that's putting the cost of asset in a asset evaluation. Now we come on a next point. Now we discuss about the liability. Liability, that's debts. It is a due amount that should be present in a negative future cash flow for the enterprise business, and you have number of example right now. Liability and honor equity. Okay, liabilities and note payable 4100,000, account payable 36,000, salary payable at 3,000. Now the total liability that's 80,000. But and now honor equity, similarly in honor equity you have a two account, capital stock and retained earnings. Okay, class. Liability again, that's a negative cash flow for our business. How it will be, how they can increase it is the all thing that relating to a credit. Okay, you are using a credit term, and we are promises to our vendor, our supplier, that company will be pay you in a future time. It is a liable for the business, your obligations. Now we talk the honor equity definitions. Honor equity represent the owner's claim on assets of a business. That's a investing amount. How much invest in a business, that just represent the amount of money that is investing in a business from the owner hand. Okay, and the owner have a claim on an asset. That's also an important concept, because with the help of owner money, owner investment, asset are making, normally a business can be able to make their assets. Okay, now the highlighted area you can see capital stock 150,000 and retain earnings the 70,000. Okay, it is a honor equity. All about the honor equity, we are discussing about the asset, liability plus honor equity. Okay, the next slide that show the accounting equation, as well as I tell you asset is equal to liability plus honor equity. Again, 300,000, that's the asset, liability is a 80,000. Look, the highlighted yellow highlighted area, you can view it easily, but more important thing is that accounting equation, how it will be make asset $300,000 is equal to the liability plus honor equity. Okay, class, finally we are discussing about these things, and accounting equation, you can easily view it and you can understand about their assets is equal to honor equity. Fine. Now we will discuss whole about the balance sheet. Okay, and in the next I will discuss the income statement and their their accounts. Okay, Allah Hafiz for this video.